For some time now, investors have been claiming, show me the money. Low levels of activity has been a key issue for the private markets over the last 18 months. On one hand, in terms of investing, we have seen young programs halting their commitments as undrawn commitments were piling up. But even more pressing, on the other hand, is the low volume of divestments and distributions. Cash flows have in fact turned negative for most investors with mature programs. All of the above, as well as other factors like the denominator effect, has led to a much more challenging fundraising environment. Therefore, the whole market is now focused on when the investment and divestment activity will resume its historical pace. Although at this stage there's no evidence of that happening, we're very much focused on tracking some early indicators and remain cautiously optimistic. The macro environment has definitively changed. Recession is no longer on the agenda. Inflation is clearly coming down, and the question about interest rates is no longer how high they will go, but when will they start coming down and how far down will they go. All of this should help to price assets and bring together sellers and buyers' expectations, which has been the main reason for many deals not coming through. Certainly, GPs are very much focused on showing the money to investors. It comes up in most conversations and they recognize that it is a prerequisite to a successful fundraising. The IPO market is slowly coming up, and we are even seeing some liquidity coming from the listed portfolio. For instance, from VC exits that after the lockups expired initially faced depressed valuations, as higher interest rates led to a repricing of the whole tech landscape. Additionally, volumes in the credit market are up, while margins are contracting. M&A activity is not yet showing higher volumes of deals closed, but the general feeling is that M&A houses are significantly busier, with a higher number of deals in the making. According to some comments we have received, the number of sell mandates awarded could be almost twice those of last year. We're also tracking exit announcements, and although these are only a proxy of exits to come, after a constant decline for the last 2 years, we're seeing now a change in the trend, and they seem to be picking up. All of this is encouraging. The world is not short of uncertainties, and geopolitical risks are at record high levels. But as public markets are showing healthy behavior, we expect private markets to follow, which should translate into an increased level of activity, investments, exits, or refinancings, and therefore of distributions in the later part of 2024.